Hello everyone and welcome to this week's edition of the TradeShark weekly blog, where every week we take a look at the features and indicators available exclusively within TradeShark. This week we will take a close look at the TradeShark predictive differences, which offer traders a different perspective of the short, medium, and long-term trend forecasts that are generated after each trading day. To demonstrate these concepts, I have created a few templates, which highlight the predictive difference that corresponds to the crossover that is displayed against the price data. You will notice each predictive difference on the lower section of each chart. This allows users to quickly switch between short, medium, and long-term forecasts while highlighting each predictive difference. Traders may wish to build trading systems that focus mainly on one type of crossover. However, most traders will find it helpful to utilize each predictive difference, not only taking note of its relationship to the zero line, but also paying close attention to the slope of each predictive difference. This can offer early warning signs of a trend reversal, as well as indicate a market trend may be losing momentum. Notice how before this trend in soybeans got started, we had a long period where each predictive difference is slanted higher. Once all predictive differences move above the zero line and the neural index is green, traders can then look to manage their positions off of these short-term forecasts. We can also see that the long and medium-term predictive differences do a great job at indicating when a top may have set into the market. Once we hit this high at about 1040, the market slowly starts to grind lower, and we can see each predictive difference starting to turn in line with that assessment. Eventually, once all predictive differences get below the zero line, and we have some crossovers from the long-term predictive moving average, the weakness really sets into the market. Additionally, we will want to combine the slope and trajectory of each predictive difference with tools like the neural index, which will always give us a highly accurate view of short-term trend direction. To demonstrate a few more examples, I have brought up this chart for light sweet crude oil, as well as a stock Chipotle Mexican Grill. So here in light sweet crude oil, we obviously have a declining market, but let's take a close look at each predictive difference. Here we can see the market moving sideways with a slight bias to the upside that we can see clearly from the short-term predictive difference. But notice what happens as all three predictive differences begin to slope lower and move below the zero line. With confirmation from the neural index, the market weakness really begins to set in, indicating that traders should look to set short positions in line with these TradeShark forecasts. Additionally, we can see later in the chart, the short-term predictive difference rapidly moves higher, warning of short-term strength, which then occurs as the market grinds higher for a few days. However, the medium and long-term differences remain well below the zero line, with the neural index confirming the continuation of the downward trend. By utilizing these tools, traders can be prepared for each trading day and anticipate short-term strength and weakness, however, not lose sight of the big picture and remain on the right side of the trend. On this chart for Chipotle Mexican Grill, we can see yet another example of how the predictive differences can assist in identifying trend direction as well as managing positions. Notice this period of time before Chipotle Mexican Grill takes off to the upside. You can see the neural index giving some strong signals to the upside, but notice how the predictive differences react here. The short term hugs the zero line and indicates the change in short-term trend direction. However, notice the longer and medium-term predictive differences becoming more and more bullish until eventually all differences point higher. Neural index confirms and the trend takes off. Using predictive differences in this way allows traders to tread lightly when there is short-term conflicts and push their trades when all the trend forecasts are in agreement. Lastly, the versatility of TradeShark allows traders to utilize these predictive differences in whatever manner works best. Traders may wish to only view one or two predictive differences at a time, or even combine the differences with other indicators like predicted strength or possibly third-party indicators that complement your trading style. For additional information on TradeShark's predictive differences and the technology behind TradeShark's forecasting ability, be sure to visit www.tradeshark.com.